What's up, YouTube? Today we'll be going over what options are and how to trade them. We will explain the difference between a call option and a put option. We'll show you how to find an intrinsic and extrinsic value. We'll explain what in the money, at the money, and out of the money means. And if you stay to the end, you'll hear a winning option strategy that you want in your arsenal today. So let's get into it. So as you see here, Apple is trading at $369.70. So that means this $367 call and this $370 call are at the money because they're the two closest to the share price. So that means anything below this $367 call is in the money, and anything above this $370 call is out of the money. So as you see, the deeper I go in the money, the more it costs to buy the option, and that's because of the intrinsic value. So let's take this $350 call, for example. So to find the intrinsic value of this, you would do the share price, which is $369.70, minus the strike price, which is $350, and that would get you $19.70. So $19.70 is the intrinsic value. And what you would do to find the extrinsic value is you would do the call option cost minus the intrinsic value. So you do $23.18 minus $19.70, which would get you $3.48, which is the extrinsic value. So the deeper you go in the money, the more it costs because of the intrinsic value, and the more you go out of the money, the less it costs because there's no intrinsic value. It's all extrinsic value. And in my opinion, you want way more intrinsic value than extrinsic value because when your option expires, if you're out of the money, this is all extrinsic value. So if your option expires with everything staying the same, with the share price being $369.70, you'll lose all the money you put into it. Whereas if you were to buy this $350 call and the share price was to stay $369.70, then you would still have $19.70 left in this call option where you can sell it for. So you lose all your money. So that's basically at the money, out of the money, in the money. So now let's get into let's explain the Greeks. So all we're gonna focus on is delta and theta. So this delta means every dollar that this share price goes up, you make $80, and this means every day that goes by, you lose $48. But you see the break even price is $373. So that means even though if this goes to $370.70, you make $80, but you still lose 48 because you're below the break even. So that's how that works. And this call option isn't $23.18, is more $2,320 because you're buying 100 contracts. So, and you'll buy a call option because you're betting on the stock going up. So if I was buying this $350 strike price, I'll be able to exercise this call option for $350, even though Apple is trading at $369.70. So that's what a call option is. Now let's go to a put option. So put option and call option are basically the same thing but reverse. So this $370 put option, this $367 put option are still at the money, but this time above $370 is in the money and below $367 is out of the money. So if you was to think this stock were going down, you would do a put option, and me, I like to go deeper in the money because it's less risk. So buy this 380 option, and same thing. The delta means every dollar that this share price goes down, you make $65, and every day it goes by, you lose $58. So that's basically a put option, a call option. As you see up here, the expiration date is July 31st. So by this Friday coming up, if this share price is the same as this, let's go back to the call option. So July 31st, if it comes up this Friday, if the share price is still at $369.70, then this wouldn't be worth $23.18. It would be worth $19.70 because the intrinsic value is still there, but the extrinsic value isn't. And now that I got into that, that's basically what the winning strategy is that I told you guys about. Stay to the end. So basically, the winning strategy is buy deep in the money with a lot of extrinsic value, so that if your call option was to expire and it didn't go up or go down, you still wouldn't lose all your money that you put into it. So let's say this. So, well, first, let's use this. So if I was to buy this $380 call option and I paid $565 for this, and the share price stayed at $369.70 till July 31st, I would lose all of this $565 because there's no intrinsic value. But if I was to buy the $350 call, I would lose $3.48 per share. So 3.48 times 100, I would lose $348. So it will go down to, so I will be able to sell this for $1,972. Whereas the above example, this would go to zero. So I would lose the full $565, but this I would lose the $348. So that's why I like deeper in the money than rather buying out of the money for cheaper price. And that's the winning strategy. And that's basically what call options and put options are. And that's what intrinsic and extrinsic value is and how to find it. And that's basically what at the money, out of the money, in the money is. I hope you enjoyed the video. Like, comment, subscribe, and turn on post notifications for my next video coming out tomorrow, telling you guys what my favorite stocks are for this week. Thank you.